Hi, I'm Greg Columbus. Welcome to Banking Compliance Insights by Wolters Kluwer, a podcast series from Wolters Kluwer. This series was created to deliver insights on compliance trends and strategies for navigating today's regulatory and risk environments. Today's episode, Loss Mitigation, Navigating Operational Challenges in a Pandemic Environment, will focus on steps servicers can take to prepare for the wave of forbearance requests that is anticipated at the end of allowable forbearance periods required under the CARES Act. Here to lead our discussion on this subject is Wolters Kluwer Banking Segment Leader, Samir Agarwal. And he is joined today by Chris Zimmerman, Senior Technology Product Manager with Wolters Kluwer, to provide expert insight on these challenges. Samir, let me pass the conversation over to you.
Thank you, Greg. Today, we're going to look at another side of the COVID-19 response from our government and lenders across the nation, specifically loan servicing. This pandemic is continuing to create one of the most significant shocks to our economy that we've experienced since the financial crisis of 2007. It could be the worst. Consumers can request forbearance with simple attestation of up to 1 year on federally backed loans. Servicing rules change fast, and they have short implementation requirements. New remote online notary and remote ink notarization acceptance is available. Digital workflows and customers and processors are now requirements just to perform. When will the end of the allowable forbearance periods be required under the CARES Act? Will there be a wave of borrowers requiring post-forbearance? Today, I've invited Chris Zimmerman, a product manager for Wolters Kluwer. He specializes in servicing technology solutions. He's going to provide us with some strategies for operationalizing servicing. In a remote environment, this is a critical path in how to assist anyone in preparedness for the incoming flux of loss mitigation activities. Chris, tell us a little bit about the solutions work that you do for Wolters Kluwer and why they're so critical in today's environment.
Thanks for the opportunity to join you in the discussion today, Samir. I'm currently a product manager for Wolters Kluwer's Expere Solutions. Expere is a centralized compliance document system that serves multiple lines of business. It provides a complete set of tools for creating, managing, integrating, testing, and deploying documents. Expere improves efficiencies with automated document selection to assembly and packaging.
So with this incoming wave of forbearance, what's the background on the current state of affairs?
The forbearance numbers are ever changing and published weekly through MBA survey data. The most recent trends show that the number of loans in forbearance has stabilized and started to decrease, but the overall volume remains unprecedented. As of July 20th, MBA data estimated that roughly 3.9 million homeowners are now in forbearance. This estimate represents approximately 8% of all mortgages. A look at the delinquency picture from Black Knight's first look at June mortgage data shows that mortgage delinquencies improved for the first time since January, while serious delinquencies soared to a 9-year high.
What does serious mean?
Serious delinquencies are those loans that are 90 or more days past due. Again, according to Black Knight data, serious delinquencies rose by more than 1.2 million as the initial wave of borrowers financially impacted by COVID-19 missed their third mortgage payment. It's the highest level since early 2011.
Wow. So that's definitely an important indicator. What else should we be looking at to get a full picture from the servicer's lens of health?
The other thing we should look at is with federal foreclosure moratoriums in place, active foreclosure inventory continues to decrease as well. June's 192,000 active foreclosures, according to Black Knight data, were the fewest on record dating back to 2000. Not surprising, there has been a sharp increase in the serious delinquency rate over the last couple months. Depending on the outcome of post-forbearance loss mitigation reviews, there could be a long tail to this through an increase in foreclosure rates. Once moratoriums are lifted, if borrowers don't qualify for a loss mitigation workout at the end of the forbearance periods.
All of this is going to be some pretty serious and substantial operational challenges for those that are servicing loans. What are some of the biggest challenges that are current that you know of affecting lenders?
Actually, Fannie Mae recently surveyed over 200 financial institutions to determine the areas presenting the most significant challenges due to COVID-19. The survey showed that the top servicer concerns included, number one, understanding and navigating post-forbearance relief options for distressed borrowers. Then secondly, gaining clarification on forbearance programs, followed by understanding and meeting evolving compliance requirements regarding mortgage customer relief. And then finally, concerns with the capacity and costs. These concerns are consistent with what we are hearing in the market. Compliance is always a concern, especially for those servicers that service loans for multiple investors, insurers, and have a servicing footprint in multiple states. The COVID-19 environment is also placing pressure on balance sheets, which we will discuss in more detail later.
So is there any advice on how we can make sure we know what we need to deal with on post-forbearance relief options?
Servicers will need to be prepared to navigate multiple investor-insurer loss mitigation programs as the forbearance periods ends. There have been recent changes to those investor-insurer waterfalls and programs. It will be critical that servicers navigate the available programs to place borrowers in the correct post-forbearance relief option.
What are some examples of those programs that you've seen?
In addition to operationalizing the requirements under the CARES Act, there have been changes to investor-insurer programs, as I mentioned earlier, and often most difficult to monitor for and implement are changes at the state level, which have included state versions of the CARES Act. On May 13th, the GSEs announced the COVID-19 payment deferral workout option. This new workout option was specifically designed to help borrowers impacted by a hardship related to COVID-19 to return their mortgage to a current status after up to 12 months of missed payments. It was really designed to be a solution that is simple to explain to borrowers as the amount of the delinquency moves into a non-interest-bearing balance, which is due and payable at maturity or payoff, with all other terms of the mortgage remaining unchanged. In addition, no trial period is required, resulting in fewer borrower touch points than required for a standard modification.
That's some pretty significant relief for borrowers. What other changes are taking place?
On July 8th, the FHA also issued new variations to their COVID-19 emergency partial claim options. Servicers are required to offer the expanded options no later than 90 days from the date of the mortgagee letter, but may begin offering those new options immediately. So I think really identifying those potential borrower touch points and ensuring consistency and accuracy in communicating the correct relief option is going to be crucial. Ensuring those communications, both written and verbal, are consistent and compliant becomes even more challenging when it feels like the requirements are changing daily. So it's really critical that servicers have sufficient monitoring processes to identify those regulatory changes, both at the federal and often more challenging at the state level. And once those regulatory changes are identified, servicers need to ensure that policies, processes, training, and borrower communications are updated accordingly. Servicers should also update their compliance management systems, have well-documented and robust training programs, and sufficient controls in place to ensure compliance with all these changing requirements.
We know that there will be a lot of change. There already has been a lot of change. There will be more change. And we need to constantly adapt the way that we're operating in this environment. What are the leading indicators from your perspective that you look at or that our servicers should be looking at when we think about the size of processing needs or how our organizations need to adapt?
While we know there's a wave of volume coming, predicting the size and timing is difficult. The recent rise in COVID-19 cases and uncertainty on what will be included in the next stimulus package further complicates matters. There's really no comparable event like the industry is facing today. The underlying cause here is a health event. This downturn is different than the impact of the financial crisis in that there was time to prepare for the increase in delinquencies and defaults. The suddenness and magnitude of this event is presenting different challenges. One way servicers can gain insight is by looking at past disasters such as the 2017 hurricanes in Florida and Texas. While people may have stopped working temporarily, most of those jobs didn't go away, except for Hurricane Katrina. Most of the downturns were short-lived and followed by a quick recovery. Past data is not perfect, but it's important to rely on the closest data available to gain valuable perspective in this environment.
That's a great parallel, Chris, drawing it to weather, because it feels like that. It feels like you never know. And there's a limited amount of forecast that's available to us. So, just based on past data being more informative, that allows us to know what we can do once we understand what's happening. But is that reliable, or is there something else that will help us also assist in some of the planning?
Certainly, Samir. One of the major challenges the industry is facing is tied to the staffing. Past data can help servicers at least perform some level of capacity planning. There will need to be frequent monitoring of reporting and resource allocation, and servicers will need to be prepared to make necessary adjustments based on real-time data. Before COVID-19, servicers were staffed for a historically low delinquency default environment. With this event hitting the industry quickly, finding and hiring the volume of staff with the required skill set in time to address the post-forbearance wave is challenging. There were also staffing challenges at the onset of the CARES Act to address significantly increased call volumes. Many servicers are finding it necessary to redeploy existing staff or outsource certain functions to reduce costs and augment recruiting efforts.
That makes a lot of sense. I've been speaking to a lot of our lenders, and that's exactly what they're doing, is they're redeploying existing staff to do new jobs and doing exactly what operators do. They adapt. You never know what the environment's going to bring, and there's always a nuance to it. So tell me a little bit more around other things that lenders are doing, or what does it do to cost?
From a cost perspective, the right to forbearance allowed under the CARES Act is placing pressure on balance sheets. Servicers are required under investor guidelines to still advance principal, interest, taxes, and insurance on loans in forbearance. The GSEs did help reduce this pressure on balance sheets by capping servicers' obligation to advance principal, interest, taxes, and insurance to 4 months. Ginnie Mae created the Pass-Through Assistance Program to cover principal and interest advances. However, servicers of Ginnie Mae-backed securities are still responsible for taxes, FHA insurance premiums, homeowners insurance, and Ginnie Mae's 6 basis point guarantee fee. Compounding the issue for government loans is the fact that those loans are at a higher risk of default. As of July 20th, 6% of GSE loans were in forbearance, while 10% of Ginnie Mae loans were in forbearance, according to data from the MBA. The recent rise in COVID-19 cases and uncertainty on what will be included in the next stimulus package will continue to pose liquidity challenges for servicers, especially for servicers of government loans.
So that's a pretty big deal, Chris, because you're basically saying the cost is rising. And when cost is rising, it's going to pose a lot of problems to balance sheets and to the ability to provide forbearance and to sustain forbearance in an operating institution. It draws my focus in on technology. And what I'm curious about is, how does technology help us solve some of the cost issues? Sure, we have to spend to get to a better path, but will that have a long-term effect? And based on this not being weather, which is temporary, do you expect that firms will make investment into technical solutions that will have long-term lasting effects?
From a technology and infrastructure perspective, many servicers continue to invest in technology that is scalable when delinquencies and defaults increase. The availability of self-service portals, allowing borrowers to send and receive documents, will serve the industry well. Those that invested in technology while delinquencies were low will be better suited for the upcoming post-forbearance volume. In addition, servicers continue to look for solutions to manage document compliance and handle the printing and mailing of borrower notices. Investors such as Fannie Mae, Freddie Mac, and Ginnie Mae also already allow for electronic signatures and remote online notarization for servicing documents such as loan modification agreements.
There's something important that you're touching on. That means if originators and loan modification processing is allowing for remote closing or remote signature, that it'll speed the process up. And should that really ultimately mean less cost?
It should. Anything we can do to improve the efficiencies in the process and eliminate paper from the workflow is going to be something that can be looked at from a cost-saving perspective, especially with social distancing requirements in place due to COVID-19 pandemic and the wave of post-forbearance workouts on the horizons. Services really have an opportunity to leverage electronic solutions to improve the borrower experience and reduce those costs we mentioned. Through borrower self-service portals, the industry is empowering the borrower, which ultimately improves the borrower experience for those facing financial hardship.
I want to touch on that also in another question. But right now, basically, I think what I'm hearing you say is the focus needs to be on borrower-centric experiences that are digital in nature. Is that right?
That's correct, Samir. And I also think it's a borrower expectation at this point, too.
How does that relate to regulatory change and oversight?
Relative to regulatory change and oversight, one of the lessons learned during the financial crisis was that you can expect frequent changes, often with short implementation timelines. Implementing robust monitoring processes along with effective controls and audit trails is critical. Servicers need to make sure they have the proper oversight of third-party vendors as well. The regulatory scrutiny was intense during the financial crisis, and you expect that it will be just as intense, if not more, with this event.
So because we have more vendors providing this technology or more financial institutions using, let's say, futuristic technology to accomplish the same task, it needs a proper oversight from not just regulatory, but also from a security standpoint.
That's correct. Yeah, oversight is kind of the name of the game in today's environment, and something that came out of the regulatory actions during the housing crisis. So if history tells us anything, we can certainly expect that regulatory agencies will be looking at, through audit processes and controls, how you manage your third-party vendors and risk.
What can we expect from the advanced technology?
Many advances in processes and technology have certainly been made since the last crisis. As we know, delinquencies and defaults are cyclical in nature. There's certainly an upfront cost and ongoing cost for implementing technology. But as you alluded to earlier, that spend gets you to a better path and provides longer-term benefits. Efficiencies gained from technology will result in longer-term cost savings. Then in the context of compliance, the risk of non-compliance can greatly outweigh the cost to invest in technology. The pandemic is certainly an opportunity for the industry to apply lessons learned and be an advocate for the borrower in these challenging times.
So it's kind of like, look at the long view, right? If you were talking to a bank executive who's making a decision around technology investment, especially for servicing or even on the origination side, there's a long view of return on investment, and it's going to be competitive and worthwhile to make that investment right now. Did I capture that right?
Certainly, Samir. Definitely the investments being made, and a lot of servicers had already learned that lesson from the housing crisis and the regulatory scrutiny that came with that, have really been making that investment in technology. So there certainly is a longer-term benefit to this, and the industry needs to be thinking outside of the context of this small moment in time and think about the longer-term benefits, especially from a cost and compliance perspective.
Let's think about that in terms of past experience and lessons learned. How do you feel the industry is better equipped now than it was in the past around managing the borrower experience? Should servicers be thinking about that themselves, or how does it also pertain to maybe employee experience for those borrowers?
As servicers navigate the road ahead, it's vital to be thinking about the customer experience. Borrowers are faced with unique and unexpected economic pressures as a result of COVID-19. The changes in economic pressures were unexpected, sudden, and impacted borrowers who were accustomed to being able to make their mortgage payments prior to the pandemic. So, really from a borrower experience perspective, that's one of the things the industry has really been laser focused on since the housing crisis. And I think, as regulators do a look back on how you performed, one of the aspects that they're going to be looking at is how you treated the borrowers through this challenging time and event.
So in the last crisis, it almost felt like it was more of a choice where a deal went upside down and we had a large amount of borrowers kind of walking away from upside down deals. In this case, it's forced, right? Same outcome, but how are we managing it better than the last time around?
Yeah, I think there'll be a combination of applying lessons learned along with technology and people playing a critical role. As I mentioned, there has been that focus on improving that customer experience. So, customer communications, both written and verbal, are at the core of the customer experience. It's really critical to know where your borrower touch points are, have consistent, transparent, and compliant borrower notices, and verbal communications are going to be crucial as we navigate through this environment.
So customer journey is paramount. We need to know every facet of our customer journey so we can help them and ultimately help ourselves.
Absolutely. Borrower education on post-forbearance relief options and well-trained staff who can keep on top of changing requirements are needed to prevent borrower confusion. A useful tool for communicating with borrowers is through the utilization of scripts. Fannie and Freddie have scripts and numerous resources available on their servicing page that can be leveraged for GSE loans and programs. Fannie Mae also provides a self-assessment document for servicers to use to help evaluate whether their COVID-19 response is compliant with their contractual obligations and the Fannie Mae selling and servicing guides. If you haven't already done so, you should also be looking closely at your borrower complaints. Complaints will be an early indicator if there may be a breakdown or other issues in your communication process that you can remedy.
Are there any mandates from the GSEs on what we should be stating to borrowers, or are they just kind of heuristics for us?
No, there are mandates from the GSEs, and it's based on the servicing guidelines. So a lot of the materials that are available on their website, including the scripts, are really tailored towards helping you and your staff navigate those investor-insured waterfalls and programs to make sure at the end of the day, you're really putting that borrower in the proper workout. So what I would say, Samir, is they're really driven along the lines of investor requirements and especially take into consideration the compliance around that.
What are some of the questions if I were to self-evaluate my organization and how we're going to navigate the borrower experience? What are some of the questions that I should be asking my own personnel or my operations staff?
Some of the key questions you should really be asking internally, ensure you have the customer experience in mind, include things like, where are my communication touch points with the borrower? Secondly, how do I better control the borrower experience? Are my borrower communications consistent and compliant? Do I have controls in place over borrower communication templates? How flexible and scalable is my technology when defaults increase, portfolio sizes grow, or new regulatory requirements need to be implemented? And then a couple other questions you should be asking yourself is, how do I prevent borrower complaints? And then finally, how do I make the loss mitigation process more efficient? So those are some of the key questions that are a good starting point to ask yourself, your staff or yourself internally, to make sure you have that customer experience in mind.
Some pretty good information. I definitely think it touches on the right topics that get us to root of managing cost and managing the experience for the right outcome. I believe a lot of our listeners will benefit from that as well. What about navigating modifications or even managing the portfolio? Where are the risks?
From a portfolio management perspective, it's really going to be, as we mentioned kind of throughout this podcast, crucial to ensure that there are no delays in your borrower outreach to discuss the borrower's current financial situation and provide the appropriate extensions of forbearance plans or place borrowers in the correct post-forbearance relief option. It's a little bit more than offering them a relief option. It's going to be critical that you put the borrower in the correct one based on their financial circumstances. The CARES Act requires up to an initial 6-month forbearance period and allows up to 12 months of forbearance. Many servicers opted to provide forbearance in increments of 90 days initially. So with the initial wave of forbearance requests taking place in late March and April, there's some data to suggest that a portion of borrowers were able to exit forbearance and were able to maintain their ongoing monthly mortgage payments. However, many borrowers require an extension of their forbearance periods. So from a risk perspective, it'll be important to have controls in place to track and monitor those loans in forbearance. Executive reporting should enhance call center trending reporting, include pipeline and forbearance plan dashboard reporting to identify COVID-19 inquiries, start, end, extensions, and resolutions. In addition, COVID-19 forbearance plan monitoring and reporting should include the customer region or geographical location. These were all recommendations that came out of the self-assessment that Fannie Mae makes available. While not specifically a requirement, they are best practice recommendations that the industry should closely look at and follow.
Is that data readily available for anyone to look at?
It is actually at the servicing landing page for Fannie Mae. There's a whole section on COVID-19 resources, and that information can all be found there.
Has there been anything to note, or has it been, exactly as you would expect based on lending in the United States today?
Yeah, I don't think there's anything maybe unexpected other than, as we mentioned before, it's a kind of evolving situation, and those requirements are changing rapidly. So making sure that you do have properly trained staff, technology and controls will be critical. Also, with those frequently changing requirements, independent quality control reviews should be embedded within the decisioning and approval process.
What else do we know?
As a precursor to what's to come, on July 16th, the CFPB hosted a webinar outlining the Bureau's supervisory and enforcement priorities as a result of the pandemic. Not surprising, the Bureau plans to focus on areas where consumers are having trouble making loan payments and markets where Congress approved special borrower protections under the CARES Act. The CFPB also plans to assess financial institutions' implementation of the Paycheck Protection Program for fair lending compliance. The CFPB has deprioritized much of its existing exam schedule to conduct what they're calling prioritized assessments. The prioritized assessments will be narrower than a standard exam in time frame and scope. The CFPB is using consumer complaints and news reports to prioritize and identify institutions for prioritized assessments. The CFPB has put financial institutions on notice. Servicers should ensure they have well-documented policies, procedures, and controls to demonstrate compliance in preparation for upcoming exam cycles.
Understood. I think that's a pretty serious thing that we need to look at, even though the exams will be thinner, that they're still going to be just as thorough. Let's switch gears a little bit here, Chris. Let's talk about how we operate in a socially distanced space. We have branches that are closing, and the mechanics of how we do our business is changing. So what impact does that have on exchanging documents, obtaining signatures? Are there other third-party tools that work really well? Or what have you been hearing in industry on how to operate more cost-effective in this environment?
Today's pandemic environment should really move the servicing industry more quickly towards the digital experience. We definitely know through conversations in the market and trending that, this is something that the industry, especially on the servicing side, is looking to implement. So historically, the servicing industry has been behind other lines of business, such as origination, when it comes to adopting digital solutions. So the standards in the origination space can serve to be the foundation as servicing moves more towards that full digital experience. Looking to streamline the delivery and execution of servicing documents, servicers are increasingly looking to adopt digital solutions to electronically route, execute, and store servicing documents. In today's age, adopting e-delivery solutions in combination with a borrower self-service portal can drastically improve the borrower experience. Servicers will continue to look to leverage these capabilities for loss mitigation and disaster relief programs to reduce timelines, streamline processes, and reduce costs.
Do you foresee any of the retention rules changing because we'll have digitization of the files and records of the transactions?
Yeah, Samir, I would say definitely. One of the things the servicers need to be thinking about is, retention of those electronic documents in the event that you have to enforce the note through a foreclosure action, for example. So I think that's certainly where the retention period could come into play and be expanded, because you never know at what point a borrower may default, may need to enforce that obligation, which would require that documentation to be available.
So there's a lot to consider with all these changes. And it seems like we're headed in the direction where the record will be preserved for a very long time. It's logical, rational, but then, burdensome at the same time. So how do you view the industry's stance today? And what are the lasting long-term effects that we should expect from coming out of this particular situation?
As the servicing industry continues to look to improve the borrower experience through digital technology solutions, consideration must be made to ensure one is aligned with any compliance requirements that may dictate how notices must be delivered to borrowers. Moving towards the digital experience in servicing will greatly improve the borrower experience in the current pandemic environment. As more states continue to adopt electronic and remote online notary capabilities, servicers will have an even greater opportunity to leverage e-sign capabilities that are currently allowed under various investor-insured loan modification programs. As of July, 26 states have enacted legislation specifically authorizing remote online notarization as an acceptable method of notarization. As a result of COVID-19, many remaining states continue to quickly pass different forms of what is being referred to as remote ink notarization that do not clearly meet the minimum standards of remote online notarization required for real estate transactions. In response, on July 1st, the MBA announced that in partnership with the American Land Title Association and the National Association of Realtors, a model executive order has been developed to assist remaining states in enabling remote notarizations during the COVID-19 pandemic. As a result, when looking for the right solution, servicers should make sure it's for the long run, with one eye toward accounting for an evolving regulatory environment and another toward making sure your processes continue to be compliant and friendly from a borrower experience standpoint.
So let's relate some of these solutions to the work that you're doing with Wolters Kluwer. Tell me some more ways that what you're doing today helps servicer during this time.
Samir, let's start with the last thing we discussed. Wolters Kluwer does have a solution to help facilitate electronic signatures. In addition, we also offer a Experience servicing solution, which includes compliant documents needed to support the investor-insured loss mitigation programs, as well as documents needed for the pre-foreclosure process. In addition to compliant documents, we also support printing and mailing services. Wolters Kluwer is also helping servicers through our consulting services, Fair Lending Wiz, OneSum X for regulatory change products.
Awesome. So I'm going to pull a string over there a little bit more. What if I don't know what I need as a lender or as a servicer? Does Wolters Kluwer offer a health checkup?
Certainly, through our consulting services, we have a whole variety of different options and services available from a consulting perspective. So we're able to accommodate any need that a servicer may have. If there's help needed, certainly one of our solutions is there to assist.
Chris, it's been a pleasure speaking with you today, and I think we've provided our listeners with some excellent information on how to work through forbearance and the typical servicing gotchas and focus points during this difficult time. Thank you for coming on today. Really appreciate your insights and look forward to speaking with you again.
Great. Thanks, Samir. It was a pleasure joining you today as well. Thanks for the opportunity to talk about this important topic.
That's Wolters Kluwer Banking Segment Leader Samir Agarwal, joined by Chris Zimmerman, Senior Technology Product Manager with Wolters Kluwer. Wolters Kluwer is the host of this podcast. Wolters Kluwer is a market-leading provider of advisory services and technology solutions for optimizing compliance programs. For more information and additional guidance, please visit wolterskluwer.com or call 1-800-397-2341 and press the number 1. Please join us for future podcasts focused on navigating regulatory compliance.